Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 12th of March 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are watching this video anywhere other than on our podcast channel, then please make sure you subscribe. In that way you will be notified of these videos as soon as I publish them. And you might have noticed today is a Thursday and I'm breaking from the usual routine of publishing videos on a Monday, and that's because there are some Mondays where there isn't very much to say, and there are many other days of the week when there is a lot to say. So I'm not going to stick to publishing only on Mondays. I'm going to instead publish the videos when I have something to say, which seems a more sensible approach. Here is the S&P 500, and if you have been watching the previous videos, you will know that this analysis that I'm presenting here is a very possible analysis. In my opinion, it is the most likely analysis, and the important feature of this is, of course, the fact that the 20-week cycle is there on the 2nd of February. Now, I've been discussing this analysis over the past several weeks, so I won't dwell on it, but it is still possible and it is still very viable. Interestingly, last week when the market came down strongly on Friday, I received several emails. There's that strong move down on Friday last week, and again on Tuesday of this week, comments from people and emails saying this must surely rule out the possibility that the 20-week cycle trough formed at the beginning of February, because that move down over there over the last few days is clearly much stronger than you would expect a move down to be into the 40-day cycle trough, which is expected round about now, according to this analysis. But in fact, that's not true. It's very important when you're analyzing markets according to Hurst cyclic principles that you don't allow the sort of sudden emotion of a strong move to overcome your reasoning abilities. And it's important always to take a look at the shapes of the cycles, I believe, and only call a move impossible when it really is impossible. I've learned that over the years. When I first started working with Hurst cyclic principles, I would often witness a very strong move and I'd say it must be impossible, that can't be the move down into a 40-day cycle trough. But of course, experience has taught me that it's useful to stick to the cycle shapes that you can see. And there we go, I said cycle shapes. As you probably know, I am very keen on cycle shapes. Some people might say slightly obsessed, but I find cycle shapes very useful in tracking the analysis and how it's playing out in the market. Perhaps because I'm a visual person, but they provide a very useful way of monitoring the analysis and seeing what is really happening. So let's quickly look at the cycle shape of the current potentially 40-day cycle, if this is indeed the trough of the 40-day cycle. And so here is the M shape. There was hardly any move down to the 20-day cycle, which probably occurred there in about the 3rd week of February. But that is the M shape. Now, if the trough forms now, or if it formed yesterday, potentially it might have, then that is the complete M shape. And that's a very reasonable M shape. It's not a very distorted M shape. It is a bullish M shape, and that's fairly important. It's a bullish cycle shape. I'm going to write that down here, if this pen will allow me to. So that's a fairly bullish cycle shape, and that's important to remember. So that even though the last 10 days of market action have been very bearish with strong sharp moves downwards, nevertheless we are looking at a bullish 40-day cycle. And it's important to remember that, I think. Let's take a look at the other possible analysis, which is, of course, that the price is now falling down into the 20-week cycle. Here is that analysis. And the highlights are that, of course, this trough back in October, as I discussed last week, is probably a trough of only 40-week magnitude. I won't go into that detail again now. Take a look at last week's video if you're interested in that discussion. Here is the 80-day cycle, which formed in the middle of December. And the 40-day cycle Trough is the 2nd of February trough, according to this analysis, and price is now coming down into the 20-week cycle. Here you can see the nest of lows for the 20-week cycle. It is a staggered nest of lows. As you can see, I've drawn two inverted triangles there. There's a distinct break between the 40-day and the 80-day cycle. Now, that's actually an interesting thing to note about the analysis. Often we look at nests of lows and we say, oh, it's a staggered nest of low, and we don't really think about what that means, but it is quite useful to think about what that means in terms of this analysis. What it means really is that the shorter cycles from 40 days and shorter have recently been stretching. And that's why this nest of lows is so staggered. All right, so the 20-week cycle, the way it's been running recently, the average wavelength recently, tells us to expect the 20-week cycle trough to have occurred over here. It was expected on about the 10th, 11th of February, according to the recent wavelength of that 20-week cycle. The 80-day cycle trough was expected just a little bit later, over the weekend preceding the 16th of February. And then the 40-day cycle suddenly jumps to the right, of course, as you can see, by, how much is that? By about 3 weeks. That's quite a big jump. That's quite a big stagger in the nest of lows. And the reason is because, of course, the 40-day cycle, according to this analysis, has started stretching. It's been getting longer. Now, what happens when a cycle stretches? What does that mean? It's not an arbitrary thing. Remember that when the underlying trend is bullish, we expect troughs to occur early. And when the underlying trend is bearish, we expect troughs to occur late. So there are two reasons why that nest of lows might be staggered. The one reason might be because the analysis is wrong, simple as that. The other reason might be because the underlying trend has turned from being very strongly bullish to being bearish. Not strongly bearish yet, certainly, but it might have turned to a bearish underlying trend. And that would cause troughs to occur late. And that is why we're starting to see some of the shorter cycles stretch longer, because their troughs are occurring later. It's a subtle point, perhaps, but that is the subtle message in that staggered nest of lows. And so you will know that, of course, I've been expecting for a long time now a big trough, a really important trough of, I believe, probably 9-year magnitude. Some analysts are speaking about a 4-year or 4.5-year cycle trough, a peak rather, but I'm expecting a peak of 9-year magnitude, so it's a really important peak, and I think markets are going to turn down and they're going to be going down. What that means, of course, is that I am expecting the underlying trend to turn from bullish, which it has been for a long time, to bearish. So I am looking for signs of that underlying trend turning, and this is potentially one of them. But let me explain why I don't believe that this analysis, where we're still expecting the 20-week cycle trough to form around about now, why I don't believe this analysis is quite as good as the other one, and it has to do with cycle shapes. Let's take a look at the cycle shapes that have been forming here. And I'm going to draw some very simple M shapes. First of all, let's take a look at the cycle shape for this 80-day cycle. There it is. That's the first 80-day cycle following the October trough. That's a very bullish shaped cycle. Can you see it has a late peak and it has a much higher trough? Now let's take a look at what happened after that bullish 80-day cycle. And according to this analysis, we have had one 40-day cycle, which was this cycle shape over here, and then of course we have seen another one which is probably approaching its end now, but let's speak about them one at a time. That cycle shape is at best a neutral cycle shape. It's definitely not a very bullish cycle shape, and it is slightly bullish because the trough that ended the cycle was slightly higher than the trough that started the cycle. So that makes it slightly bullish, but it is fairly bearish because it had an early peak. Can you see the peak of the cycle was early in the cycle, so that makes it a bearish shape. So if anything, looking at that, I would say it is neutral, but tending towards bearish, to be honest. Now, bouncing out of an 80-day cycle trough, what do we expect of the next two 40-day cycles? Well, the first one we expect to be bullish because we expect the cycle to be going up, and then the second one we expect to be bearish. So let's look at the second 40-day cycle, which is the one that started, according to this analysis, on the 2nd of February. And there is the cycle shape. I've already drawn the cycle shape for this cycle. And as I've already mentioned, it is a bullish 40-day cycle. So we have an anomaly here, according to this analysis, because here we have what I would call a bearish, and I'll just draw a negative sign, a minus sign there for that cycle, because it is, in my opinion, a bearish cycle shape. Perhaps neutral, but tending towards bearish. And the recent 40-day cycle is so far fairly bullish. I say so far because, of course, it hasn't actually formed the trough yet. It might still come down really far. There's no rule that says it can't. It might still come down even further and turn into a bearish cycle. But at present, it's looking fairly bullish. So that's an anomaly. And so this analysis is giving us two anomalies, in my opinion. The one is the very staggered nest of lows over here, which doesn't look very good, and we have the anomaly of a bearish 40-day cycle followed by a bullish 40-day cycle when we were expecting the reverse. We were expecting a bullish cycle followed by a bearish cycle. Bearing in mind, of course, that the current 40-day cycle is not yet necessarily complete, but let's consider whether it is complete or not. We can't say for certain yet, but it has been 38 bars, 38 days since the 2nd of February. Now, the average length of a 40-day cycle, you should know, is 34.1 days. So if this cycle has currently been running for 38 days, that means it is already slightly long. So we expect the 40-day cycle turn to happen fairly soon, or according to this analysis, of course, the 20-week cycle trough should be happening fairly soon. Let's count the number of bars since the trough back in August. You can see that's 148 bars. Now, the average length of a 20-week cycle is 136 bars, according to the nominal model that we use, which is Hurst's nominal model that he defined when he compiled the cycles course. It's 136 days is the average wavelength of a 20-week cycle. The current 20-week cycle, according to this analysis, has been running at 148 bars. So it's about 12 bars late, about 12 days late. That's not a huge difference, but it certainly is drawing near to the time at which we expect that bounce to happen. So I've pointed out the anomalies on this chart and this analysis. Let's take a look at the other analysis, which presents the possibility that the 20-week cycle trough formed on the 2nd of February. Now, this is still my preferred analysis, and let me show you why. It has to do with cycle shapes. Of course, we have the same bullish 80-day cycle over here coming into the middle of December. And then our next 40-day cycle was this cycle shape over here, and I'm just drawing a very simple one because you can't really see where the 20-day cycle trough occurs there. But that's certainly a bullish cycle because we have a higher trough over here, which was the trough on the 6th of January, and we have a late peak, so that by definition is a bullish cycle shape for that 40-day cycle. What about the next 40-day cycle? Well, as Hugh pointed out in the comments on the Academy, I hope I pronounced his name correctly, this big move here on the 15th and 16th of January, over there, was volatility probably caused by the Swiss bank unpegging the Swiss franc against the euro, which was a dramatic action which caused a lot of volatility in the markets. And so we probably shouldn't take those 2 days very seriously. They are what Hurst called fundamental interaction. So what about the cycle shape for the next 40-day cycle? I'm going to ignore those 2 days, and I'm going to instead say that the 20-day cycle trough was in fact over here, which is interestingly where a sentient trader has placed it in the analysis. And so that's the cycle shape there. Can you still see that? I've probably drawn too many lines on that chart. Let me quickly draw that cycle shape again, because it's quite an important point. That is a fairly neutral but slightly bearish cycle shape. Why slightly bearish? Well, because it has a lower trough than at the end. It has a lower level at which it ends than the level at which it started, which by definition makes it bearish. It has a slightly later peak, but that might be splitting hairs. Those peaks are very close to each other, and so it is a slightly bearish cycle shape in my opinion. And so you see we had a bullish 40-day cycle followed by a bearish 40-day cycle, and that is what we were expecting. Okay, that's what we expect. We expect first of all a bullish and then a bearish 40-day cycle. So in my opinion, this analysis is still in fact the better one. Of course I might be wrong, but what has happened since then is that we have seen a good bullish 40-day cycle shape develop. And as you can see, there are 38 bars. There have been 38 bars since the 2nd of February, so that cycle is due to complete and turn around fairly soon. So in my opinion, this is still the better of the two analyses, but in fact it makes very little difference to our trading. And the reason for that, and this is often the case, you've probably heard me say that before, the reason for that is that I trade interactions between price and the FLD, and if this analysis that we're looking at now is the correct one, then the next trade would be a category E long trade, which I would enter at the level of the 20-day FLD. And I will enter it with some confidence of making a profitable long trade. I should point out that the long-term 9-year peak is really expected very soon, and it is still just possible that that peak that we saw at the end of February was indeed that 9-year cycle peak, and we might not see prices get up above it. Nevertheless, I can make a profitable trade as price bounces out of the 40-day cycle trough that we're expecting now, because of course I use the FLD and the target generated by the FLD, and so even if that target is a little bit below the level of the previous peak in February, or if price doesn't exceed that peak, I can still make a profitable trade. Of course, price may well exceed the peak at the end of February. I wrote a blog post about it over the weekend, so please take a look at that and read that for a discussion about when to expect this 9-year cycle peak. And let's take a look at the option in case this analysis is correct. What is our trading decision to be made here? Well, in fact, our trading decision to be made here is pretty much exactly the same, except that we are expecting price to bounce out of a 20-week cycle trough, and so we are also looking at entering into a long trade, but it would be a category A long trade as opposed to a category E long trade. It doesn't make very much difference, except that we expect a category A long trade to provide us with more profits, to be more profitable. And so if this is indeed the true analysis, then we would expect this to be a slightly more profitable trade. But either way, I'm expecting a profitable long trade next in the S&P 500 and in the US markets generally. By the way, speaking about trading, I'd like to take just a few minutes to talk about the short trade that I took in the S&P 500 last week, which turned out to be a very profitable short trade. In last week's video, I mentioned my reservations about the category F short trade, and I'll just quickly remind you about some of that. I mentioned that because the FLD, which is over here, had got up so close up to price that potentially this might not have been a very big move down into the 40-day cycle trough. I mentioned there was the danger of that. I also pointed out, however, that if price dropped down below the previous week's low, which was at about the level of 2080, then I would be interested in entering into a short trade because of the potential that it was dropping into the 20-week cycle trough or into a much deeper 40-day cycle trough. So let's just take a look, a close-up look at the action. And I'd like to explain my reasoning and my thinking, because I think it could prove interesting. So here's what happened last week. Let's see, I recorded the video on the 2nd of March, and price was approaching the FLD. Here is the FLD, as you can see. Now, Hurst Signal subscribers who were following the trades strictly on Hurst Signals were entered into an F category short trade on the Tuesday, I believe. Let's quickly take a look at Hurst Signals. There's the 3-month view. Let's take a look at the 6-week view. And let me just zoom in a bit on that. And you can see here, there we go, the F category short trade that Hurst Signals was recommending or highlighting was entered into on Tuesday over there, okay, with the FLD right up there at price. However, I didn't do that because of the reasons that I mentioned in last week's video, and I won't waste time here going through them all again. But as I pointed out, I was interested in going short if price dropped down below the previous week's low. Now, the previous week's low was over there at around about the level of 2080, something like that. And the reason for that is because when you're making trades, of course, I follow the FLD trading strategy, and I stick to the strategy, and it's important to stick to the rules. But as you become experienced, you learn to sometimes give the markets just a little bit of room, and that is really what I wanted to do. And take a look at last week's video where I explained that reasoning. On Tuesday, price came down, touched the FLD. I received the alert. I hope you're following us on Twitter. You'll receive alerts when price touches FLDs and things like that. And I didn't enter into a trade. The next day, on the Wednesday, price dropped down, as you can see. And let me just clear that line, and then I'll do a little bit more drawing. And it came down to this level over here, just slightly above, literally just a few points above the low of the previous week. So I was still not getting into my short trade. And I looked at the market on Wednesday night, and I thought it is possible that is all the move has. Could that be, all there was to that move? It was possible. On the next day, on the Thursday, price came up and formed this inside bar. Now, an inside bar is when the high is lower than the high of the previous day, and the low is higher than the low of the previous day. In other words, it fits inside the previous day's bar. And that's always a very interesting thing to observe, and there are people who know a lot more about this than I do, but I have noticed that when there's an inside bar, it often represents a bit of a sort of a knee-jerk reaction, and often it's something that doesn't really follow through. So in other words, this bounce out of Wednesday's low wasn't looking that sort of big and positive. I was standing by, of course, to enter into a long trade at the level of the FLD, as I also mentioned in last week's video. But I looked at that inside bar, and I looked at the fact that a trough had formed just above the level of the low of the previous week, and it seemed apparent to me that, in fact, the market was not yet bouncing and there was more downside to come. As I mentioned in last week's video, I was interested in entering into a short trade. And so I did set a stop entry level at the level of Wednesday's low over there, which is just a little bit above the low of 2 weeks previously. and that was the level at which I set my entry. Of course, I got stopped into the trade on the Friday, and price moved down nicely. On the Monday, we had another inside bar with a little bit of a correction, and on Tuesday, it came down again fairly strongly. I don't know what that control is doing there, and so let's speak about what happened then. Now, I've already spent a long time talking about the fact that I'm expecting this trough, which I'm expecting actually to be a trough of the 40-day cycle. And so the category trade that I thought I was in was probably a D category trade. I know that Hurst signals are talking about it as an F category trade, but in my opinion it was probably a D category trade. Still a good, profitable, short trade, but what do you know about D category trades? They normally come down, reach their targets, and then bounce up again. So you've got to be quite nimble and quick about getting out of those trades. So I'm not going to sit in that trade and wait. I might be proved wrong, and I might have missed more profits. But at some point on Wednesday, following the good strong move down on Tuesday, I looked at the market and it looked as if though it was certainly hesitating on the way down, or perhaps it was about to form a trough. At that point, we were looking at 37 days. 37 days is a long time for a 40-day cycle trough. The odds, in my opinion, were in favor of the fact that the 40-day cycle trough was forming. I was in a profitable trade. Remember, I'd entered over here, and I'd made that profit over there, and so I simply got out of the trade. Now, I hope this serves as an illustration of how you can use Hurst's analysis and the FLD trading strategy and apply them with your own knowledge and experience to make profitable trades, even if you aren't strictly sticking by the rules of the FLD trading strategy. Of course, even sticking by the rules of the FLD trading strategy, that was a very profitable F category trade, and I think the trade 3 is still open. Trade 1 and 2 had both closed at a profit. Trade 3 is still open, and it is still a very profitable trade. But sometimes I think it is appropriate to bend the rules slightly and use one's knowledge and experience. I hope that that little bit of insight will help you to do the same thing with your trading. Let's quickly take a look at the euro. I presented a long discussion about the euro last week, and I won't dwell on that now, except to point out that, of course, the euro in the last week or two has turned down very strongly and has made the current cycle into a very bearish cycle. Let me just quickly zoom in and speak for a moment about that. Let's clear those semicircles, which are a bit distracting. And here is the current 40-day cycle. I believe that this trough here was a trough of at least 40-day magnitude. That's on the 26th of January. And so, of course, we're expecting price to bounce out of a 40-day cycle trough, at least. It might be the 54-month cycle trough that it is finally bouncing out of, but we don't know that yet. But the important thing is we are expecting a bounce out of a trough of at least 40 days. And in recent videos, I've been discussing this cycle shape for the 40-day cycle. And 2 weeks ago, or 10 days ago, I was looking at a cycle shape which is, as you see it there, a fairly neutral cycle shape, slightly bullish because the trough was still above the level of the start, and slightly bearish because the peak was very early. Of course, as I mentioned at the time, that cycle was not yet complete. The trough had not yet formed, and so as I mentioned, that was a neutral or slightly bearish cycle shape if the trough has not yet if the trough has formed, and of course the trough hadn't formed, as we have witnessed over the past 10 days, because price has come down very hard, and that has left us with indeed a very bearish cycle shape, which is what we expect as price comes down into a very major trough. That is without question a bearish cycle shape, and we do expect a very bearish cycle shape for the final cycle before the very long cycle trough, the 54-month cycle trough, has formed. Does that mean this is definitely the 54-month cycle trough? No, definitely not. And as I've mentioned previously, I'm very careful of jumping into long trades when I have an analysis that shows that it's a very long cycle trough that should be forming. And as I mentioned when we were in this situation back in January, I will be watching the next 40-day cycle shape with interest. I'm not going to jump into any trades yet. I will watch the next 40-day cycle shape with great interest. If it turns out to be a bullish cycle that develops, then it will be very likely that that very long cycle trough is formed. If we continue to see bearish cycle shapes, then of course it means that cycle trough hasn't yet formed. Let's speak for a moment about why it's proving so difficult to work out where this 54-month cycle trough is. This is the analysis. This is the longer term analysis, and it's one of the analyses I presented last week. I presented some other options, but this analysis, as you can see, let me turn that pen around, it doesn't work back to front. Okay, that 18-month cycle trough, according to this analysis, occurred over there. Why is it proving so difficult to pinpoint when exactly this 54-month cycle trough is going to occur, or potentially has occurred? Some analysts have suggested that it has already occurred, and that's quite possible. But why is it proving so difficult? The reason it's proving so difficult is because these troughs here, as of about July, or as of about July last year, these troughs have become more and more difficult to really pinpoint and identify. I've drawn circles around that sequence of troughs, but none of them are particularly strong, powerful troughs. Then, of course, the market tipped over and started heading downwards. And what has happened since then is that it's been very difficult to identify troughs. There have been some, that one there, and of course this fairly good trough in January. There have been some troughs, but they've been very difficult troughs to really perform an analysis with a great deal of confidence. So what do I do when it's difficult to perform an analysis with confidence? What I do is I will zoom in, and let's do that. And I start counting bars from the troughs that I can see. One of the problems with performing an analysis is that you pin a label onto a trough. This analysis is saying this is the 40-week cycle trough over here, and that's the trough there. And it's a very subtle, very small trough. It's not a very impressive trough, and it doesn't look very much like a 40-week cycle trough. But on the other hand, none of those troughs look very much like 40-week cycle troughs, and there must be a 40-week cycle trough in there somewhere. So one of the problems with performing an analysis, and ironically, one of the problems with getting Sentient Trader to perform an analysis for you, is that Sentient Trader will pin a label onto the trough. It'll say that's the 40-week cycle trough, and so you kind of accept that, and you say, okay, that's a 40-week cycle trough, that must be right. But at difficult times, when it's difficult to perform an analysis, I prefer to actually ignore the analysis, and in fact, for that reason, I can very simply turn it off in Sentient Trader. It's something I do occasionally. I turn off the analysis, and I look at this as a sort of a blank page, and I say, what troughs can I see? What are the troughs that I can really identify as troughs? And looking at this chart, I would say this trough over here, where's that? End of September, early October. I would say that trough looks like a trough in the price action. You could argue this one over here, but I'm going to leave that for now. The other trough that clearly formed was this one over here, the 26th of January, surrounding the Greek elections, interestingly. So again, that might have been a bit of fundamental interaction. The Greek elections occurred on the Sunday prior to the 26th of January, so there might be a reason why that trough formed so prominently in the market. But then what I do is I count the bars from those troughs. So I'm not looking at an analysis yet. I'm not saying what what magnitude that trough is, but I simply count the bars. Now there have been 160 bars since then. So 160 bars is fairly close to a 20-week cycle, of course. It's 22.9 weeks. The average length of a 20-week cycle is 136 bars, 136 days. So at the moment it's running about 24 days long. Do we expect the 20-week cycle to be running long at the moment? Yes. Why? Well, clearly there is a very strong underlying trend downwards. There's a bearish underlying trend, and I've already mentioned in this video that when there is a bearish negative underlying trend, we expect troughs to occur late. It's a very important point. So the fact that 160 bars have elapsed since that prominent trough at the end of September makes it seem likely that the market is heading down into a 20-week trough at least. And so with some confidence I could say that this trough over here is probably at least 20 weeks, and this pen is really, there we go, 20 weeks, and that the market is now expected to be forming a next trough of at least 20-week magnitude. Okay, so that's one count, and I repeat the process with other prominent troughs that I can see in the price action. So I'm going to do that with this one over here. Now that is 44 bars, so clearly that is probably a 40-day cycle, and we've been looking at it as a 40-day cycle, of course. And so I could say that this trough here is probably 40-day, did I say 40-week a moment ago? It's probably at least a 40-day cycle, and now we're expecting the market to bounce out of another 40-day cycle, trough, and at 44 bars, again, that's a fairly long cycle. But do we expect a long cycle here? Yes, because we expect a long, we expect a late trough. A late trough implies a long cycle, and so we would have expected an early peak and a late trough because of the bearish underlying trend, which is undeniably present. And there we got an early peak, and we are getting a late trough because it is already 10 days late. Now that doesn't mean that it has to happen today, or had to have happened yesterday, or must even happen this week, but we certainly do expect a bounce out of at least a 40-day cycle trough to occur soon. Most likely it should occur sometime within the next week. So I can keep repeating that process. I'm not going to labor the point too much, but I will keep identifying the cycles, the cycle troughs that I can see there, and thereby approach the analysis from a slightly different angle, if you like, a slightly different point of view. Here is another fairly prominent trough. And so that is, as you can see, a 94 bars, which is probably an 80-day cycle, which is running late. The average length of an 80-day cycle is 68 days. And so this one is running 26 days late. Okay. So again, we're expecting a late trough, so there's nothing particularly unusual about that. So from this sort of simple, slightly different way of looking at a Hurst cycle analysis, I have gathered that the trough that should be forming round about now or fairly soon must be of at least 20-week magnitude, in my opinion. That is because we have a clear trough 20 weeks ago, and so we should be seeing another one. In fact, it was 22.9 weeks ago, as you can see. And I can use the bar counting tool in Sentient Trader to count the bars between these various troughs. You can see from the 20-week cycle trough that I've identified at the end of September, there were 66 days until that trough in early December 2014. That's almost certainly an 80-day cycle, and now we're simply seeing the playing out of another 80-day cycle. Unless, of course, there was a very short 80-day cycle there at 49 days. Now that's much less likely, in my opinion. And so, therefore, I don't believe that the very big trough happened at the end of January. I think what is much more likely is that the big trough that I have been expecting for some time now is due to happen fairly soon. I'm not going to jump into a long trade immediately. I'm not going to enter a long trade at the level of the 20-day FLD. If you are an aggressive trader and you believe in this analysis, then you might do that. But personally, when a market is forming a very long cycle trough, such as a trough of a 54-month magnitude, as I believe this trough might be, then I wait for the first 40 days at least. If it is a trough of only 20-week magnitude, then I would probably jump straight into the trade, or I might wait for the first 10 days or 20 days to see what cycle shape develops. But I believe this is a much longer magnitude trough, and so I'm not going to jump into this trade just yet, but I am going to watch it with interest. Thank you very much for joining me in the Hurst trading room today, and I look forward to seeing you next time and wish you profitable trading.